For joining us for this webinar. The disembodied voice that you're hearing belongs to Chrissy Buchanan. I'll be moderating this webinar and this discussion. You can see on the right side, we have a Q&A box. Feel free during the presentation to add any questions that you might have for our presenter. And we're really excited to have you all here. So with no further ado, I will hand it over to Keith Hosmer.
Thank you, Chrissy, and thank you everyone for joining us today. My name is Keith Hosmer. I'm the director of the Construction Services Group here at PRGX. I've been with this company for about 16 years. I'm a CPA and certified construction auditor, currently in California. And I manage a cross-functional team of finance, audit, and accounting experts, as well as construction engineers and project managers, all focused on reviewing construction contracts and billings. For those of you unfamiliar with PRGX, we're a global analytics and services group founded in 1970. We are the leading provider of source-to-pay analytics and recovery audit services. So today we're going to explore why proactive auditing should be a standard part of every construction project, not just the ones with known issues. We're here to challenge a few assumptions you might have and show you why audits add strategic value even when things seem to be going according to plan. Before we dive into details, I want to briefly set the stage. A lot of you probably have projects coming in consistently on budget and on time, so why even discuss audits? There's a big difference between being on budget and being financially accurate or having your processes optimized. Even the best run projects have billing errors, hidden inefficiencies, and overlooked opportunities that can be easily missed. We're going to address 4 common misconceptions that keep companies like yours from proactively auditing their projects. We'll also explore how audits can build trust rather than erode it, and ultimately how audits can save you money and headaches. We have some quiz questions for you, and we'll save plenty of time at the end for your questions. So starting with a quick poll, if you had just one project to audit, which one would it be? Would you audit the project that went $7 million under budget, or the project that needed an additional $7 million in funding? There's no way to enter your answer. Just kind of lock it in your mind, and we will move on to our answer, and we can discuss at the end if you have any different perspectives. So actually, I think both answers are right here, but we can make a case for auditing the project that came in under budget. Of course, the projects with overruns will have additional financial scrutiny, but the project that came in under budget might not. These fly under the radars in a lot of ways. When a general contractor returns $7 million, instead of being comfortable with it because it was under budget, we should be asking the same questions that come up when the projects are over budget, right? Are all the charges allowable? Are they calculated correctly? Is $7 million the right number? And are you or your clients being shortchanged? Should the project have come in further under budget? One way to answer these questions is to consult with a qualified construction audit team. Moving on to audit misconception number 1. Audits are only necessary when something is wrong. The reality is about 80% of the projects we audit have billing errors. This is data from over 350 projects over the last 4 years. The vast majority of these projects were not selected because of known issues. We were just asked to provide additional financial oversight. Some of these errors increase costs for owners and tenants, and some of these errors can cause landlords and developers to incur additional non-reimbursable costs. But there can also be value in clean audits, right? Audits can be about more than catching mistakes. They can be used to confirm and show that the project is on track. And most importantly, audits can help identify issues before they become bigger problems. It's not necessarily about skepticism. It can be about strong financial controllership. Misconception number 2, our project managers have it under control. We've worked with a lot of great project managers, and on some projects, they do have it under control. And they're obviously crucial to the execution of the projects. But a lot of project managers are overloaded. It's not uncommon for us to work with project managers who are running 5 or more projects at a time. Project managers have to wear a lot of hats, right? They're engineers, they're planners, managers, accountants, and a lot more. It's a multidisciplinary role with a ton of responsibilities. We audited a $2.6 billion airport project for a client. It was being run by one single project manager and one accounting rep. We can take some of that responsibility off their plate. We gave a presentation to a client a few years ago, and I was sitting across from a very experienced project manager there. He turned to his peer and he said, I get multiple pay applications a month with over 300 pages each. I don't review them all, do you? So now we review those 300-page pay applications for him during audits. And we brief him monthly on what he needs to worry about, and he focuses on project execution. Another quick poll. How many projects do you think are audited each year in the US industry-wide as a percentage of project count? 10%, 15%, or 25%? It's actually only about 10%, and this really surprised us. And we think there's a lot of missed opportunities. Other than the overcharges and lost revenue, the opportunities to learn from what a financial deep dive can uncover is lost. What clients learn about their projects during audits make the next projects run more smoothly. I think that's the biggest lost opportunity for companies who don't use a third-party auditor. More proactive auditing can mean more savings and ideally smoother projects. Misconception number 3, we hear this a lot, audits cause delays, right? We just don't have time to engage with the auditors. We understand time is money, especially on construction projects, and we do everything we can to prevent delays. And in a lot of cases, audits can actually speed up project flow. When we can clarify expectations of documentation and have the opportunity to streamline paperwork, we can stop contractors from creating unnecessary deliverables and make the ones they provide more meaningful. And when we catch issues early on, we can avoid more complicated and lengthy conversations later in the project. Fewer disputes, faster approvals, and fewer holdups mean the projects run more smoothly, and we can definitely contribute to those process refinements. Misconception number 4 would be that audits damage contractor relationships. We'll be totally honest, nobody likes being audited. One of the funding partners we work with a lot said that being audited was like going to the dentist. It's not fun, but everyone knows you have to do it. But audits can actually strengthen contractor relationships if they're done right. The general contractors we've worked with tend to appreciate knowing exactly what documentation is required, the intent behind the terms of their agreements, and what the payment process is up front. We got a thank you letter from a general contractor last year, and they said they feel like they understand the expectations of their client more clearly, and that was really powerful. Audits aren't supposed to be adversarial. They're supposed to be collaborative tools to build stronger partnerships. We approach each project hoping to find a way to improve the processes so we can avoid issues in the next pay applications and on future projects. Our clients engage us in different ways. For some, we're just a final level of oversight. We engage with the contractors when a final invoice has been issued or paid. And at that point, every pay application has been reviewed by developers, project managers, sometimes internal auditors, and quantity surveyors. We're just there to validate and adjust the final billed amounts as a final level of oversight. But other clients utilize us throughout the process. During the contracting phase, we can work to strengthen contracts and avoid misunderstandings. We find a lot of contradictory terms that can cause problems later in the project, even when people are using typical AIA templates. We see a lot of miscalculations in the budgets that cause confusion later in the billings. And during construction, we can catch our issues early in the project and coordinate a resolution before project completion, ideally before they get to be large values. And we can audit a final invoice before retention is released so that when the final invoice has been paid, everyone can walk away and the books can be officially closed. So what have we learned today? To quickly recap, proactive auditing isn't about suspicion or hassle. It's about strategic financial management. Even a project that seems seamless can hide significant errors. Auditors can support your busy project managers, allowing them to focus more on execution and less on paperwork. And audits can strengthen relationships with your strategic partners. Audits aren't just about compliance and billing errors. They're about validating good work, protecting your bottom line, and ensuring long-term success. So thank you for your time, everyone. Really appreciate it. We'd love to answer any questions you may have. You can use the Q&A box on your screen. I'd love to hear if your company has used a third-party construction auditor. And if you haven't, maybe there are some concerns we can address. We've got plenty of time. We'd love to discuss anything we have or even haven't reviewed today.
Yeah, thank you so much, Keith. So we do have a few questions for you, so I'm happy to go ahead and go through those. And while Keith is going through Q&A, please feel free to submit more. I am monitoring the QAs that come in. So the first one, asking about general conditions. So how does PRGX help us with general conditions, and can you be a little more specific about that?
Sure. Yeah, general conditions is a complex billing area. I mean, anytime you have labor, it's going to be complex, right? We see a lot of contracts with cost-based labor, and we see a lot of duplicative costs in labor, right? So, for example, when you analyze what is supposed to be included in the billing rate, sometimes we'll see that things like truck charges are in there, technology charges, things like cell phones and iPads. We'll see overstatements for paid time off. We audited a project a couple of years ago where the general contractor was including a 30% markup for PTO, and obviously they weren't getting 3 months off, and that ended up being a seven-figure settlement. But also, general conditions are really where general contractors put a lot of costs that they're not really sure where else to put, right? And so inevitably, a lot of those costs can be covered by the cost of work section, specifically the section that talks about what's not allowable in cost of work. So we can make sure all those transactions are contractually allowable. We can challenge things like allocations, right? Maybe a general contractor or a subcontractor is allocating more of a project cost than they should be to that general conditions bucket. And we can do things like benchmark general conditions against other projects to make sure that the size and value of general conditions makes sense for a project.
Great, thank you. So I have another question. So this one is, what kind of savings are typical, and when do we start seeing them?
Good question. Overall, on a project, on average, is about 0.75% to 1%. Right, we find more than that in contractual noncompliance, and it's not realized because sometimes there are costs that aren't contractual that are just understood to be allowable. Right, maybe there's an email approval or a handshake deal or something like that. That 0.75% to 1% is an average again, right? As projects gets larger, that $2.6 billion project that we talked about, error rate was about 2.25%. But as the spend goes down, oddly enough, the error rates increase. So the value of the $5 million to $15 million projects, those error rates end up being closer to 2 to 3%. We've recovered as much as 6% in cost for that range. And also the realization of savings is really fast. All right, when we're auditing pre-construction, the savings are baked into any edits or amendments we're able to get into the agreement. And when we are doing monthly or quarterly pay application reviews, you should see those savings and cost adjustments being reflected in the next 1 to 2 pay applications.
Awesome, thank you. So I have another question. This one is, we've got some smaller projects in the $5 million to $15 million range. Is it really worth auditing those?
It's a good question. Yeah, and like we talked about, the error rates on those smaller projects is higher than they are on larger projects, right? With a $100 million project, we would expect to see probably 0.5 to 0.75% error rate or recovery rate. On those $5 to $15 million ranges, the average is around 2%, with as much as high as 6% on some of those projects. So we certainly do think it's worth auditing, right? We can get a good recovery as a percentage of spend. And also, our clients tend to build a lot more of those $5 to $15 million projects than they do the $100 million projects. So what you learn about those $5 to $15 million projects, when we take those learnings and those process improvements and we apply those to those future projects, the current savings and the future savings can be absolutely huge.
Great, thank you. So we have a rare follow-up question. This says, thank you. What would the first 30 days?
I'm sorry, what was that?
What would the first 30 days look like when bringing you on?
Sure. Yeah. The first 30 days is really getting up to speed. So let's say you're throwing us into an active project, for example, because the first 30 days will really depend on what phase of the project we come in on. So let's say you've been building for 4 months, and maybe you have a concern about the project, maybe you don't, right? So the first 30 days is going to be a lot of level setting and getting us up to speed, right? So you'll introduce us to your general contractors. We'll have an interview with your project manager to understand if there are any concerns about the project. We'll work with you and your teams to gather the documentation that is available. We'll work with the general contractors to gather in the contracts and the pay application, subcontracts, things like that have been issued to date. And we'll start analyzing all that data. So at the end of the month, at the end of the 30 days, we will have some preliminary findings to discuss with you and your team, and to review with the general contractor and their team. And we'll have a project plan moving forward. So the general contractor will have an understanding of what documentation they need to provide on a monthly basis. What adjustments they'll need to make to pay applications, and how those adjustments will need to be made, and what the closeout process is, when the project finally reaches completion.
Awesome, thank you. So the next question is really more about, do you have any case studies or any other examples that you can share?
We do. I think I sent you a few additional slides.
Yeah, let me pull those up.
If you can flip to, there we go. So in general, this is a representation of a lot of projects that we audit, right? Large projects with a developer, general contractor. So in general, the spirit of our audits is to go to a pretty granular level, right? We're not just looking at pay applications. We're looking at the supporting documentation that feeds up into those pay applications, right? So we're taking a look at all the subcontracts, all the pay applications from the subcontracts, and we're trying to essentially, rather than auditing a pay application, we're rebuilding the costs and trying to compare that to what was billed, right? So we've done that quite a bit on distribution centers, right? This group has been active for about 9 years. So through all of COVID, and a lot of our clients just built a ton of distribution centers during that COVID expansion period. So for that distribution center program, again, we found about 0.5% error rate. Over the course of, I think 2 or 3 years, we recovered about $29 million in costs for those clients, and the changes we were able to make to their agreements for the ongoing and future projects resulted in about $40 million in future savings. So pretty typical findings project to project on those distribution centers. We see a lot of issues with applications of markups, right? So misapplication of fee, misapplication of insurance markups. We see a lot of unreconciled job costs, just where the job cost transactions really don't support the full values of the pay applications. And we see a lot of non-compliance with the billings for the subcontractor billings, right? So you take the subcontractor pay applications, even their bids and change orders, and you compare those charges with the terms of their agreement. What is allowable in those change orders. So we will work with the general contractors and we work with our clients to adjust those costs and recalculate a final build amount on the project. And again, it's just the value in going to a very granular level. The majority of these findings wouldn't be identifiable unless we went a few layers deeper past that pay application review and got all the supporting documentation. But if there is a specific industry that you're interested in, we can cover that, or we can follow up with a meeting and we can review some specific case studies.
Yeah, I actually do have a question here specifically about data centers. So it says, how do you tailor your approach for data centers or union versus non-union labor?
Data centers are really interesting projects. We're seeing just a wide variety of different types and even different geographies, depending on what kind of service, right? Is it more of an AI-driven data center, or is it a video streaming data center? They are typically shells. I guess the difference between a distribution center and a data center is just the complexity of the build out, right? The shell construction is pretty similar. Tip up cement walls, maybe a couple floors. The data centers are going to have 6 to 15 or so server rooms, and the cost of the electrical subcontractors are just going to be huge for those data centers. And so you see an increasing importance of scrutinizing the electrician labor rates, right? Comparing them to NECA standards, right? Are they choosing a complex or very complex rate when it's pretty standard work? And also making sure all the time is tracked and all the time is supported by things like time cards and site logs, making sure that people are actually on site when they're billing. You'd be surprised. We see a lot of billings for people who aren't on site. And the other piece that we see to that is a lot of our clients have a kind of a unique contract structure for these data centers. So rather than have one contract for the entire site, so the shell and all the server rooms, they'll have 15 individual POs or 15 individual contracts for essentially the shell in each room. But what we see behind the scenes is that the general contractors are running this like one big project. And as a result, we see a lot of duplications in cost from server room to server room, and we see a lot of excessive allocations. So they don't really know if they have 6 server rooms and they have a staff of 50 electricians working on it. They don't really always know, how many electricians they have working on a specific server room on a specific day. So they're kind of generalizing those costs. And so when the project is done, it's really important to reconcile all those costs together, not project by project, and make sure that there aren't, again, those duplications or misstatements. Union and non-union is also a really important distinction. Union costs in a way are a lot easier to audit because those rates are very well defined. There's less of an opportunity for us to go back and really scrutinize what's in those rates because they are really governed by union agreements. When they are not union agreements, we'll see a lot more variability in what is included in those labor rates. There's a lot more opportunity for duplication. We see a lot fewer examples of where that time is tracked on a very granular basis, and just the controllership that they have over the non-union labor is at times a lot more loose, and we tend to find more non-compliance exceptions with the non-union labor.
Awesome. Thank you so much for being so thorough with that. And with that, I've reached the end of our Q&A questions. So if anybody has any follow-up after this, please feel free to reach out to us. Keith, do you want to give your email?
Yeah. So my email is just my name. So it's keith.hosmer@prgx.com. I can put it in the Q&A section, I believe. No, I cannot.
Yeah, and I'll be sending out an email after this session that will have a link to everything shared. So I'll go ahead and go to that screen now.
Great. I did see a question from one other person who asked if we typically get involved. I think it was during the project or at the end of the project. I'd say about half the project we do for our clients are completion, some sort of completion projects. Either the project is completely finished, or it's about to be finished, right? So we're essentially auditing a draft of a final invoice. The other half is getting us involved earlier in the process, right? Sometimes they've signed a contract and there are 2 or 3 pay applications in, and we kind of jump in and make sure that the invoices stay on track. Or we're involved in the contracting process to make sure that terms are tight, there's no duplication or contradictory terms, and there's no miscalculations in the budget. So we do have the opportunities with our clients to engage at all the different stages in the project.
Great. Thank you so much for that. On the screen, you'll see the next steps and resources. So we have some files for you to download here directly on your screen. We also have some web links available. And I just want to take just a second to remind you that we do have an annual conference for finance and procurement professionals called PRG Exchange. And that is happening in beautiful Chicago, October 5th through 7th. If you want some information on that, we have a link right here. And we hope to see you all there if you're free. So after this presentation, you'll receive an email that will have the recording. It'll have all of these links included, and you'll also receive a copy of today's presentation. And then some of the helpful links that we have here, we have the slides that Keith presented. Let's have the project manager checklist that can go over just 10 financial checks for a healthy construction project if you're interested. And we also have a button to talk to a construction expert. So if you have any other questions for Keith or anyone else on our construction services team, you are more than welcome to reach out. And I've also included 2 case studies for a retail fulfillment center and multi-facility and capital project. So I'll leave this screen open for you all to download these assets. But thank you all so much for joining us today. I'm glad we were able to go over these misconceptions with you, and hopefully we'll see you at the next webinar.
Yeah, thank you, everyone. Yeah, and feel free to email me or find me on LinkedIn if you have any questions or just want to talk about your projects. Anytime, please feel free to reach out. We'd love to hear from you.
Thank you all so much.